off of this breaker. Low, lower low, high. That's not a breaker. That's a breaker to me. This retracement, every retracement that sees it break to the upside, that's a breaker. Inside of here, in this range, that last up close candle, what is that? That's a bullish breaker. We're trading down into it, and then we have a shift in market structure right there. I want to see when this gap formed on a 15-second chart. All these boxes here are relative to a 15-second chart. You'll see it in a second. But I want you to look at the logic on a 1-minute chart. Shift in market structure on that candle right there. Then we have a candle close here. So now on this time frame, we would have this. Big paradigm shift about to take place for you. And this is institutional order flow entry drill right there, if you were trading on the 1-minute chart. Because you don't want to see this gap fill in. This smaller gap that's different shade of color, that is inside of that gap because it's a 15-second buy side imbalance, sell side inefficiency. That you want to see what? Stay open. Then you want to see it displace higher, proving that this is going to stay open. And then we have what? This rejection block is pierced right there. So then on the lower time frame, 15-second chart, we will drop down to that. When it trades into this gap that will be based on a 15-second chart, and it's also, what is it? What's this? On a 1-minute chart, what is this? That right there. It's a wick. Half that wick because it's treated like a gap. If we measure that, half of that is this. So when I'm watching price action, I don't just look at one time frame. I have a continuum of price. And I'm reading price action like this because that's exactly what the algorithm's doing. It's cycling down and then going right back up, cycling down and right back up through the time frames. So if I know I'm in an area where the 1 minute is in a buy program, if it's going to go up, where's it going to go to? New week opening gap low, because it's going to gravitate towards these new week opening gaps. It's this week's new week opening gap. It's a highly influential price action. It's like a, or not price action, it's a PD array in price action. It's like a black hole. It's not going to escape it. It's going to draw it back in. Well, we're down here waiting for it to prove they want to go up. Wonderful. I don't need to be a buyer down here when it's sloppy and who the hell knows what it's going to do. I don't need to buy this institutional order flow entry drill on the 1-minute chart. I want something that is in line after it's occurred. It's done this movement here. And then I have this wick on the 1-minute chart. That means that when we opened up here and create that separation, let me take this off for a second. That separation between that wick's high and that candle's close. Wonderful. The next candle we open up here. And does what? It trades down. There is no gap right here on the 1-minute chart, but there is a consequent encroachment midpoint of that gap on that wick, because wicks are gaps. That's the logic I teach you to have. So when we see it drop down like this in the recording I put on YouTube, you can see I executed in a market order. As it went into that, I hit it market. Rallied. And then I showed this imbalance here, trades into that, and then delivers up into the new week opening gap. Because I'm trading pre-session, that means even before 7 o'clock, I'm using the logic of relative equal highs over here. So now watch what occurs. In price, are these relative equal highs hiding from you? Were they in your chart too? Of course they were. Were you watching chart at the time? Maybe, maybe not. I don't know. But I know that there's liquidity up there. In this 2024 mentorship, I taught you to validate a relative equal high. It is a high that has a slightly lower high to the right of it. That's a valid relative equal high. That is where your liquidity is most likely going to be tapped. Can it run relative equal highs that have a slightly higher high than that one? Sure can. The key is, and this is the part where you write down shit, if you watch that one that has a higher high, if it makes the higher high with a wick, but the bodies are still showing this body close is slightly lower than that one, If the one that you think is a relative equal high, if it wicks above it, but the body still stay below the one to the left, that's still a valid relative equal high. And it'll go into the wick. You're just going to be met with the challenge of you need to see it trade above and close and show speed and magnitude above. If it has a wick, it's consequent encroachment. Okay. Remember what we were looking at when price was diving down today below its initial low after 930's opening? I said, watch the wicks. That's why you need to see, does it want to indicate that it wants to go through that? If it does, then you probably are part of a more meaningful run. Or if it does that, give it a chance to reverse and get back above it, which is what we outlined this morning, and then trade to the opening range gap again and to the buy side liquidity I outlined at the very beginning of the stream. See how all this stuff goes together? It's logic that will repeat for you. So this is the draw on liquidity. All right, so your buy stops are here. So that's where your buy side liquidity is. This is the entry. I'll show you that in a minute. It rallies, creates an imbalance here. Notice that this imbalance doesn't even match on the 1 minute chart. But we're watching it on the lower time frames. But again, what is here? When price goes above it, did we just disregard this? No, we don't do that. We take and you measure it on the time frame it exists. So there is what? Consequent encroachment. Do these candles touch that consequent encroachment? No. So while I'm watching price action, I may be showing you the execution being recorded on that one specific time frame. What am I not showing you? It's my observations through the price delivery continuum. It's watching higher time frames down to lower time frames, and I'm weighing out, do my PD arrays keep price from dropping, or if I'm expecting this consequent encroachment to trade to, which is reasonable, it's consequential. It's consequential to you holding on to the trade. So it can encroach into the mid part of that wick. Hence the name, consequent encroachment. So if I'm looking at it and it doesn't touch the midpoint of that, if I'm bullish and if I'm in a long trade, does that bolster my confidence or does it chip away at my confidence about holding the trade? If it fails to touch that midpoint, is that a good thing or is it a bad thing for my trade if I'm long and I'm trying to make a gain by having prices move higher? It's fucking wonderfully delicious. That's exactly what I want to see happen. But you aren't taught that in anything else. This is real order flow. But you're watching time frames that are higher down to the lower time frames. You're going to see things on the lower time frames that you won't see on the higher time frame, for instance, the 15-second chart. But I'm managing the expectation of what the 5 minutes doing, what the 15 minutes doing, and how many things are forming on that 15-minute chart. It's not forming like on a 15-second chart. And it's behind you after it forms. That means the price is advanced. If you're on the right side, you're moving further away from that thing that occurred on the 15-minute time frame. For instance, say this gap down here was based on a 15-minute time frame, and we're trading here. Is this all that influential in terms of watching price action at that moment there? No. So as I move away from the higher time frame PD arrays, that's supporting my confidence that the trade's panning out. I don't need to worry about the 15-second anymore. My focus drops down to the 5. And as long as I'm moving away from the PD arrays that's formed on the 5-minute chart, then that's wonderful. That's exactly what I want to see happen. But I'm watching that 1-minute chart. And then same thing, because 1 minute's going to be closest to anything less than a 1-minute chart. So the PD arrays that form on the 1-minute chart, if I'm working with a 15-second, 30-second, 45-second, or a 5-second chart, I am very, very hawkish over the 1-minute chart. I'm watching every PD array. This is an example. So if I have a wick here, the midpoint of that wick, I'm watching as it's doing this. I could see it touch that, but I don't want to see it touch it. When's the last time you were in a trade and you know what you're looking for support or resistance? And think about it, it goes in the face of trading support or resistance. You want to see price find support at support, right? I want to see it come down, touch this, and push price higher. Well, that right there is flawed logic because support ain't pushing shit. But the narrative that causes you to lose money and put false hope in something that doesn't work. I want to see a level that could support but not touch it. That right there is a whole paradigm shift. If something is reasonable to assume that this is likely to happen in price, but it can't even do it, it tells you without a shadow of doubt, it's immediate feedback This motherfucker's going up or going down in deference if it can't trade up to a level that you thought it could be, if it could be touched. Think about it. Never thought about it like that, have you? Right, because I take everything and turn it upside down. And when you do that with trading, it works. But that right there sets up the tone for it to run higher. How high can it run? Well, the draw is the new week opening gap low, right? No, because that's equivalent to and below the relative equal highs. That's over here where the stops are. This is where real orders are. Anyone that's been short, they have stop orders right there. How do you protect a short stop? I'm sorry, short position. You put a buy stop on it. So if it goes up to that level, you want to be out because it could keep going higher. You don't want to hold on to unlimited risk, right? So above highs or a singular high after the market's dropped, you don't need a book map to tell you that there's buy stops above that. Everything is in the chart. Everything is in the chart. As long as you have real-time data, you have every weapon that's available to you that's required to do well. So you can't use the new week opening gap low, which is that big bold line here from this week's Sunday's opening. You can't use that one because the barrier to getting to the liquidity is above that here by that candlestick's high. So right away we're met with, this is the initial interest. Can it trade there? And then if you start doing calculations, which you don't see me doing, but I'm showing you why I did it, and you're going to see right away this is exactly what I was doing. People that go through it and start trying to study it this way, it's going to unlock a perception of price actions you've never seen before. Everybody has a 15-minute time frame. Everybody has a 5-minute. Everybody has a 1-minute. But how they manage it, the continuum of how price is delivered through that mechanism of higher time frame down the lower time frame and then back up. Not just one side. It's got to go back both ways. And you're constantly weighing out what feedback you're getting with the PD arrays I teach. And when you can see the price action doing these elements and how it supports price continuously moving, it's not being negated. It's not eating into levels that would otherwise be problematic. Everything's supporting each other. But it's not support and resistance. It's not supply and demand. It's literally looking at how price refers to liquidity and inefficiency in the spectrum of moving in a predetermined level above these relative equal highs. Okay. But now how far? The question is always this. Where is price drawing to? Well, where's the relative equal highs and relative equal lows? Once you determine that, how far beyond them can it reach? Well, what NDOG or new week opening gap is existing beyond them? Because that's where it's going to gravitate to. So we have the buy side here, these relative equal highs at the butt end and into the lower quadrant of the new week opening gap, which is defined by that high here, this line, and this line, and the difference between them. Whichever is higher, that makes the new week opening gap high. Whichever is lower, last Friday's settlement price or Sunday's opening price is obviously the low. Okay, so that's how you define it. But the midpoint of it is here. That would be consequent encroachment. But because I want to have the lowest threshold exit, yeah, it could trade there. But what's before that? The lower quadrant level right there. So to get this price, it's going to have to book what? 19,610.50 or slightly higher, right? Right? Of course. So if that's the case, we're going to have these levels here. And just know that line, once we get above the blue line, which is the buy side liquidity here, if we have that on our chart, we can do this. We can look at a 15-second chart here. All of the things that are over here on this chart, right here, are being shown to you on a 1-minute chart, and I'm watching on a 15-second chart. Now, 15-second chart, your first time seeing it, you're going to think, wow, it's too fast. I can't use that time frame. It's too fast. It's not moving any faster than what that 1 minute and the 15-minute time frame, the hourly chart, the daily chart. If you're watching ticking price on a 15-second chart, have a daily candle chart right next to it, and you'll see it's not moving any faster. But because you're looking at the candlesticks forming, closing, creating another one, open, forming, closing, it feels fast. But when you anchor it to a higher time frame reference point, like for instance the 1-minute chart, the 1-minute chart is my guide on what I'm doing. So if I'm looking on a 1 minute chart like this, and I'm expecting price to gravitate up to that 19,610.25 level, which is right here as well on the 15-second chart. It could trade up to the halfway point of the new week opening gap, which is here, over here, okay? But I want to be able to teach my son how to get very easy objectives where it's not hard work. It's more likely to fill this one than try to reach for something that's really high and lofty, because I've been in a pursuit of perfection my entire career. And every time I demand perfection while I'm moving in the right direction, because of the aspect of the limit order meeting the spread in that agreement before I get my fill. So I have afforded myself a strategy that says, yes, I can see where the best turning points are likely to form, but on a steady diet, I need to know where the easiest barriers to profitable exits are going to be for me. Which is the easiest thing to get to? Well, it can't be the low, because that's where the actual relative equal highs are, where the buy side is, and it's just slightly above that. So that's that blue line, remember? And then above that, we have the lower quadrant of the new week opening gap. And then we have the midpoint of it. So this level here is the easiest threshold to exit profitably, even if I can't get the midpoint of the new week opening gap. So you see how I'm measuring with logic that it could go to a specific level that I can forecast, I can see it, and I can feel good in my journal and say, I felt really strong about the consequent encroachment of that level being traded to. But rules state that to have a low barrier to exit profitably, state that what's the threshold prior to that one? Well, it would be the lower quadrant of the new week opening gap. And then as price created this level here that's green, I'm looking for that to be a breakaway. And it acted as such. It didn't even trade back down into it. And then we had this gap here from where we close here. We opened on that candlestick right there. And there's an actual gap with an order block. This is a strong PD array. If you ever have an actual gap where there's no wicks and you see it after a down close candle and you're bullish, as soon as it trades down into that, that's a buy. And that's why I bought it. But it's the gap. Even if that order block wasn't there, this would have been a fair value gap. And that's what's highlighted there in blue. But as it slammed into that, I went long, entered at the market. You watched it in the recording. And then we rallied up. In this area right here, right there, that's this wick. That's what's being measured on a 1 minute chart. I'm watching as price is going up, I'm watching the 15-second destroy the midpoint of that right there, which is exactly what I want to see. And then when we start to come back down in, I don't want to see it touched. Does it touch it there? No. Then it starts to rally up. Wonderful. Institutional order flow entry drill. Why? Because we have proof that it doesn't want to go down consequent encroachment here based on a 1 minute chart. See what I'm doing? I'm measuring the strength and the magnitude that's still possible in the delivery of the price, but I'm measuring the underlying strength and seeing, does this really prove that I'm on the right side? And is the market breadth in a visual representation that can never hide it from you, is it supporting higher prices? Yes, because if it was weak and touched this level here, then it's probably going to have a deeper retracement on me. I don't want to see that. I want to be a part of a trade. I want to hold on to a trade. I want to fucking add to trades that show me all these types of signatures that tell me, no, I can't even get down there for you, ICT. Yeah, this is your shit, but I can't even get down there for you. I can't even get down. Okay, that means you're getting ready to go up for me. When it was just above that blue line, watch the recording. I raise it up to some random level that you can't see otherwise, but it's the lower quadrant. There's the buy as it happened in real time. Look at the little caret that appears right at the order block. Look at that. You see that? Beautiful, isn't it? That's the entry. All you have to do is know where the price is going to move. Where is it going to draw? Relative equal highs. Okay. How far past the relative equal highs? Well, is there a new day opening gap or is there a new week opening gap just above it? Where is it close proximity? Use that one. If the range permits it, break that range or inefficiency into quadrants. Lowest quadrant right here. What's that price right there? 19,610.25. To get that price, you got to book what? One tick above it. Bam. Look real close right here. You'll see the little arrow where I'll get out at. Bam, right there. That's the logic, folks. So now let's slide on over into the 930. It is a lot. I'm going to take these. These are just measuring those wicks on the 1 minute chart. And I don't need this. And I don't need the old lows. I'm sorry, the relative equalizer. We don't need to see that anymore. All right, so 930. Okay, so we ran up into the opening range gap, went above it a little bit, broke down. Here's a gap right there. You see that? Right there. We overshoot it a little bit. That's equivalent to a 1 minute mohawk. There's a little bit of a coloring outside the range. You have to keep things in perspective because this is a 15-second chart. And it doesn't mean that you begin a move on a 15-second chart. 15-second charts just gives you these areas of opportunity for you engaging price. It does not make the move faster, and it doesn't slow the move down. It just gives you opportunities to engage what's going to be in play. Higher prices or lower prices, okay? So we're going to go into the second drop where we're spending too much time in the opening range. We're inside this inefficiency here. We drop down after working the midpoint of it, or not the midpoint of it, the lower quadrant. We drop, institutional ortho entry drill there. Almost an immediate rebalance right there. If I was watching this live as it was going up like that, I would have commented, said, watch for an immediate rebalance. Immediate rebalance is when you have a big down close candle and the next candle opens up and goes right back up to the previous candle before the down close or the larger range candle. And when it touches that right there, that's one of the best on-side indicators that you could ever get in trading. And when you're watching time frames and you're watching and managing your trade, any instance of that occurring and you have not had liquidity taken, it didn't happen yet until that right there. See that? So it could have very easily went up and touched that candle's low. And if it did, that would be an area where I would pyramid. If I was short, I would pyramid there. And I would look for this low to show speed through it. It does. And that would be first partial. But let's go to the conversation about what I outlined real time, the live stream. So we have this area. I'm going to take this box and then that shaded blue area. Remember I was telling you that's the range between the opening price to the lowest low of the day. So now it's gone. And now that chart looks familiar again. Okay. So we went down below the lows over here. This is a 1 minute chart on the left. Low and a slightly lower low to the left of that there. So we went down below this low right there. This price action right there is this price action right here. Watch. So the market has a shift in market structure on the 15-second chart here. The same thing you see on this 1 minute candle. It rallies up. This is a breaker. This is a breaker. This breaker, this up close candle, extend that in time there. So you have a gap, which is a buy side imbalance, sell side inefficiency. And you have the midpoint of that gap, which is consequent encroachment, and then you have the breaker. So you have several things there. If you were watching a 15-second chart, or if I was trading on a 15-second chart, I would have tested the market by entering in here. Would it feed that idea? It rallies up, and it does. Then we said we want to watch it trade back down into the new day opening gap high, and maybe as low as the new day opening gap low on the 16th. Later on in the stream, I explained why, because the logic was over here with this. The bodies were respecting the new day opening gap high, and it didn't do it here. So which low am I going to refer to as a discount array for price? This one. Even though this is lower, I don't care about that. I want this one. Why? Because this one was respecting the same reference point I'm using to enter off of over here on a 1 minute chart. We want to see it open, trade down to that new day opening gap on the 16th. We get that here. Trades down, hit it, and then rallies up. Then we have displacement. We have a separation of overlapping candles, which is what we're seeing in here. All of these candles are overlapping. They're sharing the same price range. The highest high and the lowest low. They keep pricing them back and forth. And then we leave it right there. Wonderful. That's this movement right there on that candle on the 1 minute chart. That's what I said when this candle was still active on the 1 minute chart, lower left hand corner. When the candle I'm highlighting right there was still forming, had not closed yet, I said, we're going to see a fair value gap, and I would like to see it create an institutional order flow entry drill. That means go one tick below this candle's low, and then rally up to new week opening gap low, and then we'll see what it does after that. Well, we get that here. Boom, boom, rallies. See that? This, we don't want to see that close back in. Why? Because we're close to a target. And if it's going to go here, it's probably going to run this high. Because there's stops right before this drop down here. Anyone short, where's it going to place their protected buy stop at? Right above this high. So if it's going to go here and trade into this old opening gap, which is shaded in pink, that's the difference between yesterday's settlement price and where we started trading at 9:30. That's the opening range gap. Price eventually trades up into there and hits the new week opening gap high. Look at the bodies. Look at the bodies respecting that on a 15-second chart. Buying and selling pressure causes that, right? Buying and selling pressure causes that much of respect of a level that's supposed to be randomly pulled out of my own ass? No. Come on, man. Then you have this inefficiency down here. And go over to the left. See that? So this singular candle and this singular candle here are sharing space. The same space. The same range. And it passed through with one single candle on the downside here and on the upside here. Go back and listen to the time when we were trading here. We can see it drop down below the new week opening gap low and trade into the inefficiency right here, but this is a balanced price range because we passed through it here and we passed through it here. So between this candle's low and that candle's high, that little box is balanced. It's like a brick fucking wall. It's like, you will not pass me. Why? Because it's in a buy program. It's going to be reaching for the liquidity. Here, and where we mentioned earlier, where the buy side was eventually, we saw traded to. But the point was, I can see this. I'm watching this, and I'm pairing this up with this over here. So just as much as this is a balanced price range, this candle in the lower left-hand corner, that candlestick's high, and that candlestick's low, those two price points define where two candles back-to-back have traded in both directions, passed through multiple times in that range. So if I can see those types of signatures in price action, it's two forms of it. Single delivery down here, one candle. Gap. Well, now we passed through it. So we offered what here? Buy side. What's missing over here? Buy side, because it only had one single candle going down. So in a perfect world, a balanced market, a efficiently delivered market would have the range open all the way up to here and pass back through it. Because only this single candle for 15 seconds only passed through the range of the previous candle's low to the candle's high here. So between those two price points that's shaded in this blue, it only offered movement going to the downside. How many times could someone buy or sell in that 15 seconds? Not much. So what's it inefficient? It's inefficient in the scope of price moving up doing that same price range, and we get it here. Okay, so because we have one single pass on this candle and this candle here, I see that visually as a balanced price range. It's offered both sides. It's true because we have not seen what? The buy side that was going to be targeted, which is the 638.75 level. What does the market do? It trades down. Watch the bodies. The wicks can do what? Do the damage. They can trade outside the range. So I'm looking at this as a balanced price range, but I'm anchoring it to what logic on the 1 minute here. As I'm referring to this candlestick here and this candlestick, that's a balanced price range. But it looks visually like this on a 15-second chart. So there's more room for it to have this little errant price action there, but it's not errant on this time frame, because watch. We're inside that balanced price range. It did not take out that candle's low. That's reasonable. It's like a brick wall. You're not going to go past me. Past what? The low of that range that's defined by that candle. Balanced price ranges are an efficient delivery mechanism. But if they ever fail, that's a huge, huge indication that something has changed. And it's manual intervention. Because algorithmically, the price is going to respect these types of things. But if they stop, the hand's in the mix. The hand is the market maker. The people that are going to push price beyond where you think they're going to go, even my stuff, even me taking a trade, it's not going to work. They're just going to upset it. And that's okay. I can accept that. Problem is, can you? Remember the analogy I gave you when Neo in the book, or not the book, the movie The Matrix, and he sees that black cat walk, and then he looks over and sees it again, and he says, well, that's weird. That's deja vu. I just saw the same cat twice. And they all knew because of experience, shit's changing. We got to go. The agents are on our way or on their way. There's a change in the matrix. They made a change. That's manual intervention. The same thing when I'm watching price visually and I see things like a balanced price range break. What I think was underway is changed. It's not likely to occur. Here, that's not the case. We're seeing this candle's high, that candle's low because it's moved back and forth. In that range, we're not concerned about price going below that. We're seeing it deliver up, down, up, down, up. You see it? That's the balanced price range here on the 15-second chart. But visually, it's this. This candle's high, that candle's low. But it's occurring right there. Did that candlestick go below that low right there? No, it didn't. So what's changed? Nothing. Everything's still valid. That's why I was telling you. I believe we're going to go down to this little area here in the inefficiency on the 1-minute chart, but not go below this area here because this is a balanced price range. This range high, that range low. Listen, go back and watch the recording. It's there. This is the part when people watch these portions of it, it sounds like, oh, he's making up shit. I get so tired of saying this shit that if you just listen, I'm telling you this stuff before it happens. Now I'm explaining in ad nauseum the details as to why it's doing what it's doing, what it looks like, how to recognize it. Remember pattern recognition? When you're hunting something, you have to know how to track it. This is what a track of this balanced price range looks like. And you can see it going back down into that balanced price range, but not going past it. It says, no, you're not going lower than that. So any retracement down like there, that's not changing anything. It's breaking the hearts of anybody that, may be trading against it. Maybe they're long up here. They chased it, and it's dropping down here, and now they're scared. Like, oh, it's going to keep dropping. No. The market rallies back up, finds some support at the new week opening, got low again, and then here. And I was telling you, watch. Look what it's doing here. Yeah, it's finding support right at the middle of the opening range gap. That's what this is. Okay, the opening range gap. I'm going to take that off. When you take this stuff off like this, it's like, what is it doing? It's hard to discern what it is it's trying to do. But when you start looking at what the algorithm will refer to, these are what the reference points that the algorithm is going to refer back to. And it's going to behave based on this. Nothing else. And then what does price do? Everything Daddy fucking says. And the market rallies up. Comes back down. Small little retracement. This is the old relative equal high. Which is now, as it retraces, is what? It is a discount array. Old highs are the highest discount array. Old lows are the lowest premium array. So if you have a reference of where the market's going to draw to, up or down, every time you breach a PD array, you got to look back at the range it just traveled through and map out each PD array. Did you miss a PD array not being traded to? Did it totally disregard it? That's a good thing. That's a good thing. That means you're on side. All those things are indicative that you're on the right side of the marketplace. So to answer the question in continuity, and what I was referring to last Friday when I was saying, when people are asking me, how do you hold on to trades? How do you trust trading and catching big moves? Well, I talked a lot about that. I did a clinic on it today. In the market trades back down in, relative equal lows, sweeps it, doesn't touch the new week opening gap here, high. And now we're just meandering around. And this is a 15-second chart. Breaks down. Where's the trade back into? New week opening gap high. What time of day is this? We're in lunch. So what can the lunch market time do? Retrace on what's been profitable. So it goes back against what was been underway in terms of higher prices or lower prices. So it's going to seek the sell stops on moves that's been going up, or it's going to seek the buy stops on moves that's been going lower. Look at the reaction off of that and where we're at here. If you don't extend the new week opening gaps on your chart and keep them on there for a few weeks, you're trading blind. Like you have no idea why the market's doing what it's doing. I'm going to do it eventually in the future. I'm going to say something that slips. That's a slip of the tongue, but that is a Reaper fair value gap that I showed the other day, and I told you to project it through, extend it through, and how many times it used it. Key takeaway: what is August 1st? First day of the week. What time did that gap get referenced? It happens every single month because the algorithm will go back to a specific date. What date would it use? First trading day, first day of week, Wednesday, previous Friday. That's not all of them, but I'm proving that there is an algorithm and it's going back to days specific. Why? Because it has to go back to a frame of reference. We're in a new month. Okay, what month are we in? August. Let's go back to the first day of August. Use the first pertinent PD array of August. Carry it through your chart. And you're going to see shit that you never saw before.